The recent economic downturn has opened the doors to the type of wealth building opportunity you only see once in a decade. From 2010 to 2021, the S&P 500 only had 2 negative years. When the pandemic happened, many thought that the party was over, but the exact opposite happened. Tech companies made record profits during the lockdown, and so did online shopping platforms and entertainment services like Netflix. But in 2022, a lot of these big players saw their revenue drop. Tech stocks took a hit, and the economy in general slowed down by a lot. The S&P 500 is now down more than 20% since the beginning of the year. The last time this happened was in 2008, and if you had invested a lump sum at the bottom of the crisis then, you would have almost tripled your money by now. Apart from the 1929-1932 crisis, there hasn't been a single year in almost a century of stock market history which returned a negative result after a previous drop of 20% or more. But what if this time was different? In this video, we'll go over 3 doomsday scenarios that show us that even though we may not have seen the worst of this crisis yet, this is an amazing time to invest, even if you only have $100 per month, even if this turns out to be only half the bottom of the crisis, and even if the next 10 years are going to be a recession. So first, a little refresher. Dollar cost averaging. In this video, we're only looking at doomsday scenarios through the dollar cost averaging approach because it's the most realistic for the average Joe, and it's also a rock solid strategy that builds amazing financial habits no matter the economic context, basically. Dollar cost averaging is the practice of investing a fixed dollar amount on a regular basis regardless of the share price. It's a good way to develop a disciplined investing habit, be more efficient in how you invest, and potentially lower your stress level as well as your costs. Many studies show that lump sum investing, which is investing a certain amount of money only once, is more profitable than dollar cost averaging. But as I've covered in some of my previous videos, this is only true when comparing the two strategies in absolute terms. Yes, $10,000 invested once yields better returns than $10,000 invested over 30 years. That's $200 per month. But $300 per month for 30 years gives better returns than $10,000 invested once 30 years ago. And since most people don't have $10,000 at hand to make a lump sum investment anyway, they go with small monthly investment. And that's way better than to never start. It's better to start small than to never start. So doomsday scenario 1, another 25% drop. The lowest point of 2022 for the S&P 500 was September, where it bottomed at 25% from the beginning of the year. Since then, the index has been kind of hovering around that low, and it's now up 6% from that. If this happens to be the bottom of the crisis, there is literally no better time to invest than right now. And if it's not the bottom, and we're in for another 20 to 25% drop, dollar cost averaging will protect your portfolio. This graph here shows a perfect example of doomsday scenario number 1. Back in October 2007, the economy starts tanking, and by September 2008, the S&P 500 is down 25%. We think it's a great time to start investing $200 per month. And we do just that, except as we keep investing, the index loses an additional 37%. That's a major drop. It bottoms in February 2009 and then picks up again from there. And this is what our portfolio value would have looked like during that period. From $0 to $1,027 during the worst crisis of our modern times. Not too bad, but not so fast. It's very important to understand here that we still technically lose money. We only made up for the losses with our monthly contribution. Dollar cost averaging is not a magic recipe to make money while the market crashes. It's a disciplined approach to setting aside money no matter the economic framework, and it yields exponential returns no matter when you start, but especially when the economy picks up again. To better understand this, it helps to look at the total invested amount versus the final balance of our account. We invested $200 times 6 months, that's $1,200, yet we end up with $1,027. That's a loss of 14%, but we mitigated risk and will benefit even more when the crisis is over. Doomsday scenario number 2, a 10-year recession. Another notable negative event in economic history is the dot-com crash of the 2000s. It started in the late 90s and exploded right at the beginning of the new millennium. Not only did the S&P 500 lose 40% from 2000 to 2003, even when it picked up again, it didn't cross its 2000 peak value for another 13 years. It did briefly surge 1.48% above it in October 2007, but it crashed 50% right after that. So imagine if you had started to invest $200 per month right at the beginning of 2000. How much would you be sitting on in 2013 while the S&P 500 essentially stagnated for 13 years? Well, here it is. That's right, on the eve of 2013, in March, right when the S&P 500 crossed its peak of 13 years ago, you would be sitting on $45,800. Your portfolio would have won money 8 out of 12 years of the recession, that's 67% of the time, and you would have won money 84 of the 158 months of the recession, that's 53% of the time. Doomsday scenario number 3, a further massive drop, aka the apocalypse. Here are the top worst years ever for the US stock market. We can see from this table that the S&P 500 never lost more than 50% during any given year since its creation. This means that if it was to lose more than 50% right now, this would be a once in over a century event. We have no precedent for that, so we can't go back and look at previous historical data to project a potential future as we did in the 2 previous examples. However, if this was to happen, we know that the S&P 500 would fall from a high of nearly $4,800 to around $2,400, and that would take us back to the bottom of the pandemic crash, and before that would take us back all the way to May 2017. If it were to pick up again from there wouldn't be a better time to invest in the entire history of humanity. But again, it could also drop further, and then what? Then most people would probably have a lot more to worry about than investing in the stock market. Anything below $2,400 in value would mean potentially a 50%, 60%, or even 70% drop of the value of 504 of the biggest companies in America. That's trillions of dollars just wiped out and millions of layoffs, as we're seeing in the tech industry right now, for instance. And with inflation potentially making matters even worse. And most people are already short on savings. In June 2022, 61% of Americans were living paycheck to paycheck. So if all this was to happen, the world would probably enter a new era of even more tragic inequalities and crumbling economy. Maybe we would have to come up with a new economic system, start from scratch, create a new stock market, finally sanction all the capitalist, monopolistic mammoths who gobble ginormous amounts of money for the past 2 decades without having to pay taxes on them. I don't know, we may have to do that. The economic doomsday would also add up to the already fragile societal order, so institutions would probably fall apart, people would revolt, kind of like what is happening right now, but 10 times worse, basically. In conclusion, successful investing is about managing risk, not avoiding it. And dollar cost averaging is a great way to manage risk for multiple reasons. It gives you psychological safety, it allows you to keep cash at hand, it can actually make more money than lump sum investing if you don't do an absolute comparison. For instance, $100 per month over 30 years is better than $10,000 invested once 30 years ago. It builds amazing financial habits and forces you to budget. It makes up for losses when the economy is doing bad, and it grows exponentially when the economy is doing good. And finally, a small increase in monthly contribution has an exponential effect on future portfolio growth. At the end of the day, remember that nobody knows if the stock market is going up or down, but only those who take a reasonable and calculated risk and grow their portfolio over time will profit from the economic cycles in place. Thanks a lot for watching. As always, thank you so much for your time. It means the world. Don't forget to like and subscribe if you enjoyed the video. Don't forget to also check out my 75 People Who Do interview PDF. I interviewed a ton of productivity experts on money management, productivity, self-improvement, good work habits. It's full of knowledge and resources in there, so make sure you check it out and you get a discount because you watched this video. Thanks so much. Thanks again. I hope you have a wonderful day. I'll see you in next week's video. Enjoy the journey you're on.